Welcome back to the Abundant Culture Podcast, where business owners like you come to learn how to grow the valuation of their companies so they can sell in the future. On this show, you'll learn how to sell for top dollar and invest in profitable businesses around the country. Now, here are your hosts, Jazz and Joe.
Welcome back to this week's episode of the Abundant Culture Podcast. And this week, Joe and I wanted to talk about why, in our opinion, business is better than investing in real estate. And you can go ahead and take it away with the first one.
Yeah, so this will be a somewhat probably controversial episode because I kind of learned business from real estate. You know, like when I was broke, didn't really have any money. One of the first books I read was Rich Dad, Poor Dad. And that made me wanted to invest in real estate. And I ended up eventually getting, mentored by real estate investors. And they taught me, a little bit of the ins and outs of real estate transactions. But I was never really great at real estate. Plenty of people who are much better at real estate than I will ever be, even with, having owned different types of businesses and things of that nature. It's just, I think real estate is a lot more competitive. And I think there's people who have been doing it longer. So the barrier to entry, even though you can get in, I feel like it's really hard to get great. And when I mean great, I don't mean like, just being good at it, but I mean like you're one of the top in your area, in your state, or in, your region, or whatever the case may be.
Because anybody can go out and just buy like one or two single family homes and rent them out, but not everybody will have like thousands of units of rental property, or if you're not doing rentals, having like flipping over 100 houses a year, not everybody can get there.
Yeah, absolutely. I think it takes a specific type of person, specific type of skill set. And I think you have to have a passion for it. And to be honest, I like real estate as an investment. I think it's very, very cool. I think it's one of the best investments out there, but the key word is one of the best. And I still like it, but I think that there's perks that you can get from owning a small business as opposed to real estate that you can't necessarily get with real estate. And also, a lot of the stuff I'm explaining here, I actually have a lead magnet that will probably go somewhere in this episode that will kind of explain in further detail why we think small businesses are the best asset class on the face of it. And one of the disclaimers that I do want to say before getting into that subject matter, I do want to say that I believe that real estate is easier to get into than small business, but I also believe that small businesses will make you wealthy easier than real estate will. I think real estate takes a lot more reps and iterations to become wealthy in that. I think small business does not take as much. And the reason I say that is, one of the reasons I believe that small business is better than real estate, which is kind of surprising to people when I say it, but I believe that it's actually safer. Now, I don't mean that it is safer for somebody who is new to both of them. If you are new to real estate and also new to small business, you are definitely going to have a much better chance with the real estate than you are with small business. But if you drop an expert in real estate and small business, they are going to crush it in both, but they're going to make way more money in small business.
An example of that, a really good example I just thought about, is if any of you have watched, or if the listener has watched the Undercover Billionaire show this season with Grant Cardone. And everybody knows Grant Cardone as real estate guy. And in the show, he shows that he's not doing real estate. We actually haven't finished the season and watched past like the first couple of episodes yet, but up to like episode 3 or 4, he was not doing real estate. He had 90 days to make $1 million business, and he only had $100. You can't buy real estate, or I guess you can sometimes, but it's highly unlikely with $100. He went out and he started doing marketing for another company. So in a way, he was kind of like creating a marketing company, which is a small business. Didn't get into real estate. He got into small business.
Yeah, and kind of going along with the idea that small businesses are safer, the reason I believe it is for somebody who knows what they're doing. Not for, if you're a newbie, real estate wins that. if you're not a newbie, if you know small business and you kind of understand real estate, you're going to make more money in small business. And the reason why is that in real estate, your cash flow, your net worth, your balance sheet, your P&L, your cash flow statement, all of that is determined by the amount of units that you have. So if you have one unit, it's really hard to get the same amount of cash flow that you would get from that one unit that you could get from 20 or 30 or 40 units. Even if that one unit is like, a pretty big house or a mansion or whatever the case may be. So the amount of money that you're making is always dependent upon how many units you can acquire. So that means if you start with one, then you have to figure out how to get two, and then you have to figure out how to get four, then you have to figure out how to get 10. And I do understand that a lot of people skip to 10 and then 100 and then 150 units or whatever the case may be. And I do think apartments are really, really cool. But I believe, and here's what it comes back to. The thing about small business that you can't say about real estate is with a small business, it's one of the only asset classes that you can overpay for and over leverage and still get a phenomenal return just by growing the business. If you overpay and over leverage a real estate deal, you're going to lose money guaranteed. That's just like a no-no in real estate.
That was 2008.
Go to any real estate investor and tell them, hey, I'm going to pay 10% above the value for this property. And then I'm also going to leverage it, like over leverage it as well. You're not going to make that much money off that property, regardless of whether it's a 1 unit, 100 units, 200 units, it doesn't matter. For a business, people overpay for businesses and then over leverage businesses all the time. But if they keep some of that capital and put some of that capital into the growth of the actual business, it's going to be worth more in almost no amount of time. See, with a small business, people go from, doing almost nothing in sales to doing over $1 million a year in sales in less than 2 years. And they can do that with one business. That's not including buying another business, doing another acquisition. You can't make a real estate deal that's not really generating any money. You can't boost that to $1 million unless it's like, an apartment that you're fixing flipping. But for the most part, if you come into a real estate deal, the way you're adding value to that, if it's an apartment, is you're decreasing expenses and then you're pushing rents as high as you can go in the market.
To the market rent.
Yeah, to the market rent. And the thing about that is, the key word is market rent. So you can't go too far above market rent most of the time, unless you're doing like short-term rentals or something like that. But for the most part, you can't go too far above market rents. And the thing about it is, if you overpay for that property and you over leverage that property and you go to market rents, you're still probably not going to make much money, if not, no money at all on that property. Whereas in a small business, I can own one small business, which is, comparable to one unit. And that one unit that's doing $100,000 in profit, or even let's say no money in profit whatsoever, you can push that same business to $300,000, $500,000 in profit. And a lot of times you can buy one business and that location, you might only have one location, but that location, let's say, is doing $100,000 a year, which is not bad in cash flow. You can push that same business that's doing $100,000 in cash flow all the way up to $500,000 on average. There's ways that you can quadruple or more the cash flow of one small business. And it's something that my mentor has done many times over. I haven't done it that much, but it's something that he's done many times over. And I'm still, always getting coached on how to, do that and do it better. And he's done that with one location. Imagine buying another location and that's doing $400,000 in cash flow. Now you took a business from doing $100,000 in income, net income, all the way to $800,000, and you own 2 locations, not dozens or hundreds of units. So I think the ability to scale sales in a small business actually mitigates the risk of that small business.
Whereas, and you can really charge anything you want for your products and services. I mean, people get away with it all the time. Like, for example, some of our prices are more than Starbucks.
Yeah.
I don't think we lost any customers after
Nope.
we increased our prices.
Yep. And not only that, I mean, there's like, I talked to one business owner. He's like, oh yeah, I increased my prices like by at least 15-20% over, during the course of coronavirus. So he increased his income by 15 to 20% on $1 million business. That's 150 to 200 grand with the same amount of sales, and nobody even noticed, nobody batted an eye. He didn't have to deal with somebody moving out or getting mad trashing his unit because he increased his prices by 20%. He didn't have to worry about that. So I do think that a lot of people, when they say that, business is more risky than real estate, I do kind of think it's a cliche, because when you analyze the numbers, I mean, base your opinions off of numbers. I mean, numbers are the only things that's not really, your opinion. They're just numbers. When you base it off of the numbers, when you know what you're doing, if you don't know what you're doing, like I said, it doesn't apply. But when you know what you're doing, if you look at the numbers, if you look at a real estate deal and you look at a business deal, the business deal, it has a much better likelihood of success, just as long as you know what you're doing in business, which a lot of people may think they do, but they don't. Like, I know people who've been in business way longer than I have, and they're making mistakes that I made last year and stopped making like last year, and they're still doing it. So it just kind of depends on your expertise in that area.
If you own a small business and you might be looking to sell, you could run into some major issues. Forbes estimates that 9 out of 10 businesses listed never actually sell. Why? Because there's only one way to sell. You need to do these 4 steps first. So if you want to be a part of the 10% of businesses that sell for profits, we've created a free checklist for you so you can sell without those hurdles that normally hold you back. Download the free checklist by visiting www.abundantculture.co/checklist.
The other reason why I believe businesses are better than real estate as an investment is because of the way that they're evaluated. So you ask any real estate investor, what's a good cap rate for an apartment? Like, cap rates depend from, place to place. But if you give anybody a double-digit cap rate, which we can have another discussion about what that actually is, but if you tell somebody this property has a double-digit cap rate, and guess what? It's a B-class property. I know investors who will step on you to get to that deal. They will literally step on you. Now, the thing with a small business is it doesn't necessarily go off of cap rates. It goes off of multiples, but let's call it cap rates so that we're comparing apples to apples. And actually, let me explain cap rate. So cap rate is what's called the net operating income divided by the purchase price. So you can consider it the cash flow. It's not necessarily the same as cash flow, but let's, for the sake of people who don't know, it's like cash flow divided by the purchase price. Cash flow before your debt service, I'll say, is probably the simplest way to put it. If your cash flow before you pay any loan payments is, let's say, $100,000, and your purchase price is $1 million, or the purchase price that you want, or the purchase price that you actually sold your building for is $1 million, then $100,000 divided by $1 million, that is 0.10, which is 10%. Now, in businesses, it also sells off of a multiple, but for the sake of this conversation, we're going to call it the cap rate. It's a similar idea. For a small business, it's not uncommon for them to sell for what's equivalent to a 20% cap rate or more. So what that means is that for a small business, the average small business is going to sell for a 20% cap rate. And that's just the average deal. There's businesses that sell for the equivalent of a 30% cap rate, a 35% cap rate, even a 50% cap rate. And those deals are literally everywhere. In real estate, it's either one, a home run deal, like literally deal of the century, or B,
It has foundation issues.
yeah, or it's basically like it's a gut rehab, like there's nobody living in it. You can buy a business that's cash flowing already has customers, already has 7 figures in revenue, already has 6 figures in cash flow, and buy that business for, let's say it's cash flowing $200,000. You could buy that business for $1 million, at least $1 million, and your return off of that, if you bought it cash, is 20%, which that beats most real estate. And that's an average deal. I guarantee you, if you go on business buying website, you'll find that deal. You'll find it like that. It will not take you no time. You won't have to dig. You won't have to send out 1,000 postcards or letters about let me buy your building or your business. It's just something that is easy to find. It's pretty much everywhere. And because of the way that businesses are valuated off of a multiple, and usually the multiples are between literally 1 and 5. That's the usual. It does go up to like 6 depending if the business has a lot of assets, but mainly between 1 and 5 is the average multiple of cash flow or net income that you'll see a small business actually sell for, which makes it a great investment. The less you have to pay for the same cash flow, the more cash flow and the higher return you'll actually make off of a certain investment. And I have not seen any asset class, period, that produces the same amount of cash flow per dollar that a small business. So because of their valuation, I think they're better.
And the final point that we want to leave you with is that we're not bashing real estate, because we know that real estate is a great vehicle to increase your wealth, but we like to use business to gain the wealth and then real estate as a way to store it.
Yeah.
And the point being is that you can do both. You can combine them.
Yeah.
If you could actually get a business with real estate attached to it, and it can make it even more secure for you. So it's not I forgot how the saying goes, if or both and kind of statement or whatever, how it goes, but it's not one or the other. It's we need to do both, but when should we do both?
Yeah, absolutely. I think when you're in a stage where you're building wealth, you're going to build more wealth quicker owning small businesses. However, I think that real estate can be really simple when you reach a certain amount of wealth. And also, if you're making a killing in business, you're going to have a tax liability if you aren't literally investing all of that cash back into your business. So maybe you're investing some cash back into your business, but you still have a whole bunch left over. If you put that into real estate, it's going to offer you a lot more depreciation, which is a tax write-off that the IRS would give you, than business would. You can depreciate assets in a small business, but there's more assets to depreciate in real estate. So you'll actually get to ride that tax benefit for a lot longer in real estate than you can in business. In business, you probably can depreciate the whole business out in like 5 years. With real estate, you could depreciate a lot of the assets out within 5 years, but some will take 7, 10, whatever the case may be, depending on if you're using what's called accelerated depreciation, which is another conversation for another day. But let's say you make a ton of money from your business, you can put that into real estate, and now you can get cash flow almost tax-free with a very, very little tax liability. So I don't think it's one of those things that you have to choose, but I do feel like people aren't necessarily exploiting the strengths of both real estate and small businesses. And I would like to see more people do that. You know, there's a lot of people who invest in real estate and they live and die by it. They won't invest in small businesses, which I think is fine. I think we live in a free country. You deserve to be able to think like that. But I do think that people will reach their financial goals a lot quicker, a lot easier, a lot faster if they use the method of buying and growing businesses and then using that income, that cash flow, to buy real estate so that they're getting more cash flow, but they're not really paying as much tax on it. So I think using a combination of both is really, really powerful. And I don't see a lot of people doing it, but it is something that I do plan to do in the near future, especially when that tax liability becomes a lot more hefty than I can handle.
Right.
But I'm not there yet. So right now it's pretty much just
all growth, buddy.
Yeah, all growth. But yeah, feel free to reach out to us and let us know what you think about that. And back to you.
And yeah, that is it for this episode. I know this was very, very number specific, and maybe you didn't follow along. Maybe you have specific questions. Just reach out to us and we're happy to answer them. And thank you for listening, and we'll see you next week.
Thank you.
If you don't diversify your investment portfolio, you could end up losing it all. but most business owners don't know how to diversify to mitigate those risks. That's why we created this resource for you. This passive investing guide is a must-have if you're planning to invest in businesses. Don't hesitate. If you have more than 25 grand liquid, then you can't afford not to take advantage of this resource. Download the 4 reasons why in 2021 you need small businesses in your portfolio now by going to www.abundantculture.co/guide.
Thank you for listening to the Abundant Culture Podcast with Jazz and Joe. If you enjoyed this episode, make sure you subscribe, then leave an honest rating and review. And remember, we're ready to buy your business. So if you're ready to sell or passively invest in other small businesses, go to abundantculture.co for more information. We publish episodes every Friday, so we'll see you next week.